Making mistakes is a part of life, but when it comes to investing, even small mistakes can have big consequences. That's why it's so important to avoid common pitfalls and make sure you're positioning yourself for success. In this video, we share 10 of the most common investing mistakes and how you can avoid them. So whether you're just starting out or have been investing for years, read on to find out what to watch out for. Trust us, it could save you a lot of money and headaches in the long run. Mistake number 1. Not doing your research. Before investing in anything, make sure you understand what you're getting into. Whenever you're considering investing in anything, it's essential that you do your due diligence. It's easy to get excited about potentially profitable opportunities, but if you don't do your research first and understand what you're getting yourself into, you may be taking a lot more than you bargained for. Take the time to read up on the market you're looking at and consult with experts in the field so that you can make an informed decision. Investing shouldn't be taken lightly. Rushed decisions put your money at risk, while knowledgeable decisions create smart investments. Ultimately, it pays to invest wisely, both in terms of knowledge up front and logical financial choices down the road. Mistake number 2. Not diversifying your investments. Don't put all your eggs in one basket. Investing can be tricky business, and diversifying one's investments is an important principle to understand. Placing all of your eggs in one basket is a huge mistake when it comes to investing, since it exposes you to a much greater degree of risk. A well-rounded portfolio will contain both stocks and bonds, as well as some more creative investments, such as Bitcoin or real estate holding. This kind of diversification allows for higher returns with much less worry about large price drops in the future. The benefit of taking the time to properly diversify investments, thereby decreases your overall risk, is something that small businesses and savvy investors have long recognized. Investing in options that are uncorrelated helps ensure positive growth over time by spreading out risks involved with certain investments, while continuing to increase a portfolio's value. Mistake number 3. Buying on emotion. Don't let emotions like greed or fear guide your investment decisions. Investing should always be based on rational thinking and data-driven analysis. Emotional factors like greed or fear can cause investors to make decisions that are far from logical. For example, fear of missing out may lead to entering the market late and buying high, while an exaggerated sense of security may lead one to hold on to investments too long and sell at the bottom. In other words, when it comes to investing, it's crucial not to let emotions get the best of you. Instead, setting up rules and a comprehensive strategy ahead of time will help ensure you make rational decisions with your investments. Mistake number 4. Chasing performance. Past performance is no guarantee of future success, so don't get caught up in the hype. It is always important to remember that past performance is not a guarantee of future success, and chasing the hype often results in disappointment. It can be difficult to remain level-headed when presented with unlimited potential and realistic predictions of success. It is tempting to jump at the prospects of outrageous returns. However, investing possesses risks as many factors can contribute to a rise or decline in performance. As such, investors should be conscious of the risk associated with any given investment, so that they are not taken by surprise no matter the predicted trajectory. By reviewing past performances cautiously, investors can make more informed decisions while avoiding the hope of tangible riches that may never materialize. Mistake number 5. Failing to rebalance your portfolio. As your investments grow and change, so should your allocation of assets. As anyone investing knows, it is important to diversify. However, too often, investors forget that non-diversified portfolio must be rebalanced over time. Failing to regularly review your asset allocations as your investments grow and change can result in unintended increases of individual stocks or sectors that may no longer meet your risk tolerance level. This could lead to putting too much of your capital at risk by gambling on one security. Rebalancing is an integral part of staying disciplined when it comes to managing a portfolio to achieve both short and long-term goals. By rebalancing, you'll provide yourself with more opportunities for increased returns and reduce the amount of risk associated with single stock purchases. With market fluctuations up and down, it's essential that investors have a plan in place and take action in order to make sure their portfolios are diverse. Mistake number 6. Not having a plan. Know what you want to achieve with your investments and stick to it. Knowing what you want to achieve can be the difference between making and losing money on your investments. Without a clearly defined plan and goals in mind, investors run the risk of being misguided by fluctuating markets and trends. To reach financial success, it is important to set objectives that are actually achievable, as well as continually evaluating and re-evaluating your investment portfolio. Having a strategy that will give you peace of mind, knowing that you are on the road to achieving your desired outcome, whether that may be steady income from dividends or capital growth from stocks. As most know already, taking some time to plan ahead can save future headaches. Having a plan is key for successful investments. Mistake number 7. Waiting too long to start. There won't be the right time. Investing is a great way to secure a financial future, yet too many people end up waiting around for the right time before beginning. The truth is, there's never a wrong time to invest your hard-earned money and start building towards that financial stability. Waiting for long periods of time can be costly in terms of missed opportunities, as markets tend to fluctuate. Investing today might even mean more profitable returns if held until the optimal time in the future, so now may actually be the best time after all. Don't make an investing mistake by waiting too long. Take advantage of every opportunity. Mistake number 8. Investing money you can't afford to lose. This can have serious consequences. Whether it's due to poor planning or an emotional response to a hot tip, investing money that should be used for day-to-day living expenses is never a good idea. Also, taking on a high amount of debt or borrowing too much money in order to pour into stock market could easily backfire and result in crippling financial difficulties if the investments don't pan out as expected. Not only does this put your financial security at risk, but it also puts unnecessary pressure on yourself as you try and make back the money you invested in order to cover your regular bills. By evaluating one's current financial state before making any sort of investment decision, potential investors can avoid putting their finances at risk and ensure that the returns earned from investing are rewards rather than needed funds for basic living expenses. To ensure success when investing, avoid putting any of your essential funds into investment. Always keep some liquid cash available for emergencies or unexpected costs. Mistake number 9. Chasing after the latest and greatest investment fad. It's not a get-rich-quick scheme. If you're looking for fast money, you'll be sorely disappointed. Instead, investing requires patience, discipline, research, and knowledge, all of which are essential to making sound decisions about your investments. Unfortunately, many investors make the mistake of chasing after the latest and greatest investment fad or trend in an effort to make quick profits. This can lead to disastrous results as these strategies often fail to deliver on their promises and can cost investors dearly in losses, both financially and emotionally. Therefore, it's important that when investing, you take a long-term approach by focusing on quality investments that have proven track record, rather than being swayed by short-term trends or hype. Mistake number 10. Not thinking long-term when you make investments. Making investments without taking the long-term consequences or lack of them into account is one of the biggest mistakes an investor can make. Failing to think ahead and lacking consideration for the potential returns over time can lead to investments that may not be sound and could negatively impact results for years down the road. To ensure a good return on investments, both short-term and long-term, investors should always think downstream and consider how their decision now will affect outcomes later on. Analyzing a variety of prospective scenarios, both good and bad, can help inform a wise decision, one that will yield success in the present day as well as in the future. In order to avoid making investing mistakes, it is important to do your research, diversify your investments, and have a plan. It is also important to think long-term when making decisions about where to invest your money. Remember, past performance does not guarantee future success. If you are thinking about making an investment, make sure you fully understand what you are getting into, and always think about how the decision will impact your financial future. Now we're at the end of this video. If you got value from this video, you'll also like these videos. Thanks for spending time with us.